This is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Andrew Gaiziunas of Turbadium. Andrew, thank you for joining us.
Nice to be here. Thanks for inviting me.
So what was your background before coming into the world of crypto?
I've been in the technology sector since the mid-90s, back when it was easy for a 17-year-old kid to find six-figure jobs working in software. And the typical vanilla career path in 18 years at IBM and HP, built a billion-dollar business unit from the ground up, made a ton of money, left it all behind, kind of started focusing on more interesting startups. But where things really started to change was probably like the Ron Paul presidential campaigns back in 2008 and 2012. Like most of my generation, I was pretty apathetic when it came to politics, but his platform resonated. And like a lot of Ron Paul acolytes, I naturally got immersed in researching monetary policy, central and fractional reserve banking models, things that had never even been remotely interesting in the past and became ideological cornerstones. So I think it's a little bit of a perfect storm, putting technology together with some of those tenets, and the advent of blockchain technologies are really allowing the implementation of that in the real world.
Well, it sounds like you've followed blockchain for a period of time and have seen it go through a number of stages and evolutions. How do you see the industry evolving today? Where do you see it coming to?
Well, I see a lot of parallels between, I lived through the dot-com revolution as well, so I see a lot of parallels between that and what we saw back then. I mean, to me, this is a lot very similar to, the late 90s, 1997, 1998, and the dot-com boom, where there's a lot of great innovation happening and new use of the technology, but also a lot of overhyped examples of pimenteloaf.com where people are just throwing business models to the wall just to see it stick. And it's made it a little bit easier with these ICO vehicles that have been to this point less regulated to kind of monopolize on that hype. But where it's going is going to lead to some very drastic changes. I'm one of those believers that sees this as bringing about changes on par with, if not even slightly eclipsing, the Industrial Revolution.
So the investing landscape has changed quite a bit, even from 2017 to 2018. Last year, people were taking their token, putting it on exchange, selling it for a gain, and doing all kinds of fun things with it.
Yeah.
Then the SEC came in and said, well, that's really a security. Let's apply security law to it. And so it seems like everything's a security now. But how do you see investing in blockchain changing from last year to this year on the investor side?
The market's starting to mature a little bit. You're seeing some of the hype kind of fade away. People are less inclined to just jump into the ICOs just because they're an ICO, just like those previous parallels to the dot-com boom. And people are starting to investigate more of the underlying fundamentals of the business model. Now, there's still this perception out there that blockchain is this magic technology, that anything you throw on blockchain is going to magically work wonderfully and beautifully and disrupt the whole market space. But I think that what I see is a lot of old world business processes and models, and they're just trying to kind of shoehorn it onto the blockchain and using blockchain as a differentiator, saying, well, we're blockchain based, so that's why we're better. But really, that technology can make certain models even worse off than traditional implementation. So it's maturing. People are getting a little bit smarter. There's still some of those market makers out there that buy ICO tokens on a pre-sale on a private discount and just cash out and get their 20% and move on. But especially with the advent of some of these security token marketplaces like the T-Zeros, the Polymath, some of those guys, where you're going to have startups finding funding online in the form of tokens, a la almost crowdsourcing style, but with some regulatory oversight. That's where it's going to get a little bit more exciting, because we'll see a little bit more velocity in the growth of some of these startups. And for the investing side, it makes it a little bit more bite-sized and also gives you liquidity to exit without at any time you want, rather than sitting there and waiting for a public offering.
Well, do you think the SEC is going to walk back their stance that all tokens are securities? It seems like some people were starting to telegraph that in communications a couple of weeks ago, where we could see the way that some of these tokens could really be utility tokens and not everything's a security. I've always, at some point, they'll tease it apart, but do you think they'll go that direction?
Well, sure, yeah. And Hester Pierce even kind of alluded to some of that a few months ago when she gave that talk, and saying that they're more like the lifeguards on the beach, and they're not there to interfere with people building their sandcastles. They're just there in case they see a kind of like emergency somewhere. So they're there to protect the mon-pas, or the non-accredited investors, to some part, to some of these fundraising. Now, one of the things that I think that gets conflated a lot is this question of tokenization. What is a token? Is it a security? Is it something else? Well, in our mind, it really is what it represents. I mean, it's just a vehicle at the end of the day. I mean, you could say if the token represents a securitized interest in a business or a property, then yes, it's a security. If the token represents just some imaginary commodity that's fungible and mined kind of like Bitcoin, then no, it's not. So it's just a vehicle, and what it represents will determine whether it's a security or not, in my opinion.
Well, it seems like the SEC is looking at not what people intended the token to be, but what they can actually do with it. I can call my token a utility, but if somebody can take it and throw it on an exchange and sell it for a gain, well, then that is a security. And so one of the reactions to this SEC law is to start coming up with other models for tokens like the stable coin. The coin never changes value. It's always fixed in value. Therefore, there's no gain to be made on it, and that takes a lot of the wins out of their sale. The other is to say, well, the token never leaves the platform, so I can never go sell it to anybody else. And again, that is another angle that goes into it. Do you think those are long-term solutions or short-term band-aids for this current situation we're in?
Well, I don't want to get too into depth on stablecoins because those are a bit of a pet peeve of mine. Most of these are structured in a way to try to engineer an instrument that tells the markets what it's worth, which in the history of man has never worked. And the free markets will always find the cracks and make those implode. So they're using a lot of different artificial means that aren't. Blockchain is great, but it doesn't suspend the laws of economics in any way, right? So those stable coins are kind of like a favorite whipping boy. But at the end of the day, I think the Howey test is still applicable. I mean, nobody's kind of moved on from that as the gold standard. And even in the startups I've been involved in, where we've started out with a legal team that actually eclipses at a ratio of 5-2 or 5-3 the software engineers, and make sure that whatever's being structured is legally sound, and then design the technology around that. And that, I think, is a little bit more of a viable approach, where just take the existing precedent. And then there are some new models that don't have these precedents that you can rely on, but you can still abstract and pull from different models and present a case to the SEC or present a case to the regulators saying, hey, look, this is how we envision our model to be. Do you agree with it? Give us an opinion letter, or give us go rely on outside E&O with a bunch of firms to give you their opinion if you have to. But there's ways to mitigate that risk.
So you have a broad view of this blockchain world. What's your investment thesis for this sector? Where do you think the wins are going to come from at this stage?
Well, so it's been maturing from what you can think of as the first generation cryptos, the Bitcoins. It gets into the second generation, which are like the Ethereums or distributed apps and computers. Third generation is more specific app focused on a specific market or task. And now you've even got some fourth generation ones that are coming out that provide bolt-on capabilities to other protocols. So there's a lot to pick from and choose from. The first generation is kind of tapped out. Those are just like the false or the imaginary scarcity, the commodities of scarcity willed into existence like Bitcoin. Those are pretty much tapped out in terms of investment potential. But the second generation ones also, there's a few dominant players in there that they've already kind of taken over a lot of the market share. There's going to be a couple of competitors coming to that to compete with guys like Ethereum. But I think the third and fourth gen ones are the ones to focus on. And again, I think to draw from earlier comments, not looking for people that are just taking existing business models and putting them onto the blockchain, but rather eliminating entire steps of certain models. So take, for example, getting rid of intermediaries, whether that's a fractional reserve bank or a lender or some kind of centralized institution. Blockchain allows to create this decentralized level playing field where you set the rules in advance, and now everybody can come in and participate with those rules with 100% transparency. So that closes a trust gap where you don't need some of these trusted intermediaries anymore. Those are the types of models where you're taking out these high cost, low value middlemen that just detract from the model because they were necessary but no longer are, right? Those are the ones I think are most exciting.
And are you seeing a lot of those examples come onto the market? The press seems to trumpet the ones that didn't make it. 40% of ICOs of 2017 are already dead, got quite a bit of play. But what about the ones that are making their way out into the market and starting that long, slow march up the curve? Are you seeing good examples of that?
Oh, yeah. It takes time. There was such a gold rush for the ICOs, and you can't blame them. I mean, everybody, what they did is it's just like in the IPO craze of the dot-com boom. Everybody just kind of threw a model out there, raised a bunch of money. The failure or the flaw in the ICO model was that the founders would stick 40% of their issuance in the safe somewhere, make the rest of the circulating supply go through the roof or go to the moon with hype and marketing, and then dump their supply and then go retire on a beach somewhere. It's not a long-term viable business model. Now that you see a number of folks coming out where even like the startups I'm involved in, that they're going the traditional route for financing, not even doing an ICO, going and building a long-term business model that's got revenue projections and an actual value that it brings to the market space rather than just, hey, look, we're putting REITs on a blockchain. Yay, right? That's some of those are just, I think you're seeing those fade away, and you're seeing the larger, more mature market players come to bear. Now, that doesn't include some of my other favorite whipping boys, and I don't want to get too specific and name names, but there's some large financial services companies that are creating some of their own cryptos because they want to get in the game. They're still kind of approaching it with that old model of, hey, look, we can print up our own money. All right, great, let's go try it. But like I said, I don't want to poo-poo anybody specifically on the call here.
So for the startups that you work with, what are their challenges in putting these blockchain applications together today? What do you see them struggling with the most?
The lack of regulatory precedent is always first and foremost, I think, on anybody going into this space, that you're blazing new trails. Are you a money services business? If you're involved in lending, but you're not the lender, the network, it might be the lender. You can actually have the obliger and the obligee be the same person. As I mentioned, this is enabling a lot of new models. A bailment system where the bailer is the network and the distributed community, and the bailee is some token holder. It's creating a lot of new models that never existed, where you don't have certain counterparties that the regulatory bodies can lean on anymore. So, well, what are they doing? Well, they're leaning on the technology providers that develop the software, develop the network itself. So that's I think first and foremost. And as I mentioned before, there's a lot of ways to mitigate that risk, but I think that's probably usually one of the bigger red flags that you're going to come across. A lot of geopolitical uncertainty in terms of if you're trying to get into certain markets. Governments are still around the world are still a little bit hesitant to either embrace or completely try to block out crypto. That's going to have to work itself out a little bit. My personal position on that is, with time, everybody's going to embrace crypto because it just brings a wealth of economic benefits. But the regulatory side, I think that uncertainty and blazing new trails is probably the biggest risk factor.
And for the investors out there trying to figure out how to navigate these waters, there's plenty of risks. There's always risk in the startup, but even more so in the blockchain. What do you think are the key risks they should be looking at that just kind of separates it out from everything else? Is it regulatory risk? Is it team risk? What do you think is the risk they should be viewing in this time frame?
I mean, team risk is no different than in other traditional models. I think the typical due diligence will uncover that. I think the regulatory is a side of things is definitely a big one. The competitive landscape right now, a lot of this stuff is, if you thought of it, there's a bunch of other guys out there doing it as well. And it's very tempting to jump on board, because if you think about some of these models, they have a little bit of a social media aspect to them as well in terms of gaining critical mass. The first movers are often the ones that really kind of dominate the market, especially when it comes to like liquidity solutions that are based on the blockchain, where you start getting a big enough circulating supply. Now everybody wants to use you because you're where the liquidity is at. So it is kind of tempting. Now, on the same time, a lot of these guys are making technical shortcuts. They're basing their platforms on third parties. They're basing them on Ethereum or something else, where if you look at the business model long term, and if you map it out to what is it really going to cost per transaction down the road, especially if one of these underlying platforms makes a tweak like charging rent for storage or increasing their transaction fees or the underlying gas going up in value, you can probably eliminate half of the startups right away because they're just not looking enough towards the future. So that, I think, just the detailed analysis and the game theory of taking it out to its 5-year eventual goals with all its functionality is probably the more technical analysis side of it.
So blockchain is coming into just about every sector: supply chain, healthcare, fintech, et cetera. Where do you think the immediate wins will come from out there? Have you seen anything or any sectors you think are far ahead of the others that might have the early wins?
Yeah, well, on the enterprise side, you're looking more at the consortium or the private blockchains. And I think, supply chain, healthcare, those are definitely areas where you have a lot of co-opetition, and you have competing parties that want to band together in order to take advantage of some kind of a market force that benefits everybody across the board, but they want to do it in a way that they can trust each other or don't need to trust each other. That, I think, is certainly on the enterprise side. On the private side, I think you're going to see more on the financial services. It's such a low-hanging fruit and dominated by such a small number of players right now from a traditional standpoint. Legal monopolies on the fractional reserve banking side. I think you're going to see a lot of fintech come out on the more distributed peer-to-peer permissionless blockchains.
So that's great information. In the last few minutes we have of the interview today, what else should we cover that's top of your mind?
When you look at this space, thinking about it from what's coming 5 years down the road versus 10 years down the road and 15 years down the road, there's Right now, I think the focus is just on the guys coming to market in the next 18 months. And sifting through that noise, I think, is something that if you don't have somebody that's like technically capable or doesn't have background in game theory, those are the types of people you probably want to be looking out for. These are the type of resources that if they have any exposure to the space, they're very quickly in certain markets asking for 300 grand, 350 grand a year. They're starting to price themselves appropriately. So the earlier you can kind of get some of that expertise, I think that's something that might be overlooked right now.
Well, appreciate you sharing your thoughts with us today and hope to have you back for a follow-on soon. How best for the listeners to get back in touch with you?
They can reach us at turbadium.com, or my email is just andrew@turbadium.com.
Great. We'll put those in the show notes and make that available to people. Appreciate your taking time to share this with us today and hope to have you back shortly for another one.
All right. Sounds good. Thanks for the talk.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.